Morning. Thank you for tuning in today. I'm Steve Biggs, a member of the CFA Society of San Francisco, part of our Member Programming Advisory Council. It's my pleasure to welcome you to our webcast on the Fed's impact on valuations and where do we go from here. Our speaker today is Tim Urbanowitz, Head of Investment Strategy and for Innovator ETFs. A quick item to note before we start, we'll be muted for the event. So we encourage you to type your questions in the Q&A box and we'll monitor questions closely as we endeavor to have as many answered as possible. This event will also be recorded, which we will share the replay. Now I'd like to introduce Tim.
Thanks so much, Steve. I really appreciate it. As Steve mentioned, I head up research and investment strategy for Innovator ETFs. Quick introduction to Innovator. Innovator is the creator and the market leader in the defined outcome ETF category. We were founded by two of the original founders of the firm PowerShares. If that name rings a bell, it's actually, believe it or not, the fourth largest provider of ETFs in the world now, under the Invesco name now. But really excited to be here. Spent a lot of time talking with our clients about what we're seeing in the markets, what we're seeing in the economy, really how a lot of our solutions can help. And then also a lot of time on the portfolio construction process as well. So very excited to be here and looking forward to the discussion today, Steve.
Well, good, I am too. So it has certainly been a challenging market this year for investors with, not only stocks taking a pretty good hit year to date, but also other asset classes down as well. So, here we are 9 months through the year, almost 3 quarters. What do you see as the biggest challenges for investors right now?
Yeah, it's a good question, Steve. And I think, really all year long, one of the challenges that we have seen is the same risks that are plaguing the equity market are the exact same risks that we see coming from the fixed income markets right now. If you think about really what has been the headwind so far, we all know it, but inflation, overly aggressive Fed, and higher interest rates. And really a lot has changed in the first, call it 8-9 months of the year. You have higher interest rates. That's a big deal. But at the end of the day, that backdrop really hasn't changed. And those key risks that we see really impacting the equity market are the exact same risks that we see impacting the bond market. And just to kind of put this backdrop into context for everyone on the call here, I had a few slides that I wanted to share. And this one in particular has really been my favorite chart all year long. And a couple things that we're looking at here. Number one, if you look at that yellow line on the chart, that yellow line plots the effective federal funds rate, so where the Fed is at. And that kind of dark green line on the chart looks at CPI. It looks at inflation. And what you'll notice if you turn your attention all the way to the right-hand side here, what we're looking at there is the disconnect between the two. Now, yes, that gap has closed a little bit, or has closed meaningfully since the Fed began its hike cycle. But still, even with the moves that we've seen thus far this year, we're still seeing one of the biggest disconnects that we have ever seen in history between where inflation is and where the federal funds rate is. So what that told us early in the year is that you have a Fed that was behind the curve. But really what it shows us now is that you still have a Fed that likely has a lot of work to do to get this situation under control. And really there's two things that I think are really interesting about this chart. One, you look at that gap. Yes, clearly there is a disconnect between the two. But if you look across the dots that I have on that chart there, the green dots and the red dots, what those green dots show is every time historically the Fed has kicked off an interest rate hike cycle, and the red dots on that chart show every time they have stopped an interest rate hike cycle. And what you'll see is that never before in history have they kicked off a rate hike cycle with inflation above 5% and a recession not been the solution to the problem. Said another way, never have they been able to hike rates with inflation north of 5%, and they've been able to pull off a soft landing. So when I look at this in the context of the portfolio, what we really see is that the need for risk management remains very, very high given this dynamic. But at the same time, when you look at the go-to risk management playbook that our investors use, i.e. using bonds for protection, that playbook is extremely vulnerable simply for the fact that higher interest rates are part of the solution to the dilemma. So when we think about the challenging backdrop, this is really, this really summarizes it in that you have the same risks that are facing the equity market and the fixed income markets. So that has been challenging all year. And in reality, when we look at the backdrop moving forward, we continue to believe that's going to be the case moving forward because those risks really haven't been resolved up to this point.
Yeah, that is interesting. I see the reason they started so late is that, you heard a lot of transitory commentary, and despite very high inflation and strong economic growth, the belief was that it would dissipate, over time. And I think we've seen some slowing, but certainly well below what was expected.
Yeah.
I mean, despite, falling energy prices and, just the calendar effect of rolling off the base effect, it seems to still be surprising on the upside. What's your outlook on inflation from here?
Yeah, it's really interesting, and Steve, I think you hit it on the head there. When you think about that transitory and all of that talk from last year, it was always surprising to us, simply for the fact that it's very inconsistent with what we've seen historically. When you look at periods of high inflation across the globe, and just for the sheer fact that the amount of money that was printed throughout the pandemic, it really was, I would say, just completely disconnected from reality. A couple things that I think are really interesting, and I want to get into some different pockets of inflation in a minute here, but just in the context of this inflation, this narrative that inflation is just going to revert back down to 2% as all of the pandemic-related spending fades. All the extra unemployment benefits go away; they fade into the background. We're just going to revert back down to this, this 2% target. And again, when you look at this in a historical context, not at all consistent with what we've seen. If you look at that chart on the left-hand side that I have up here, what we're looking at is developed economies from 1980 through 2020, and the amount of time that it took them to get inflation down to 2%. Now, we're only looking at periods where inflation was north of 5% here, but what you'll see is that it has taken, on average, a decade when inflation is above 5% to revert back down to that 2% target. And in fact, the least amount of time that we've ever seen inflation take to come back down has been 3 years in the Netherlands in 2001. So again, very inconsistent with what we've seen historically, this view that, yes, you're just going to see inflation revert back down to that 2% target. The other thing that is really interesting, and our team has done a lot of work on this, is just looking at the time that it takes for Fed interest rate hikes to actually make their way into the economic data. And we all know it takes time, but on average, typically that it takes about 9 months or so to show up in the economic data. So it's going to take time here. And one of the trickiest components of this, which honestly, and we'll talk about this in a little bit, is probably the saving grace as well. But if you look at the employment or the job market here, the job market has been very, very stubborn here, and you've seen very, very strong jobs growth, very slow unemployment, but also what we have seen historically is inflation will struggle to come down until you have a meaningful deterioration in the employment picture. And just one example of this in the US here, if you look at the last time inflation was this high, throughout the stagflationary 1970s and early 1980s, what we're looking at here on this chart on the right-hand side is non-farm payrolls growth and plotted against inflation, which inflation is the the line across the middle there. And you'll see that really, you didn't see inflation come down until there was that hit to employment each and every time. So I think the bottom line here is you just need to be cautious with that view that inflation is all of a sudden going to revert back down to that 2% target. The reality of it is it could take some time. And when you look at different pockets of inflation that are being impacted, you look at shelter costs, which make up a very, very high percentage of the basket, the inflation basket there. They're sticky. Those are sticky costs, and they really haven't showed any signs of peaking yet. So, certainly encouraging to see some of the other pockets like energy coming down. But the reality of it is, this could take some time to actually play out.
Yeah, that's interesting. So, a lot of what happens obviously with stock prices and bond prices are, what investor expectations are. And kind of what you're alluding to here is that people may be overly optimistic about the pace that inflation comes down and how aggressive the Fed may have to be. I mean, what do you think is priced into the market at this point?
Yeah, in terms of what's priced in, I think it was encouraging to see, and we've been out on this for a while, but at least there's some recalibration of the expectations for the pivot. I think the market has kind of given up hopes of that anytime soon. But really, what it comes down to, I think, when you look at what is priced in, the difference between where equities are right now and where they're going, in our opinion, is less so about the pivot when that happens, and more so about how the economy handles the rate hikes that have been dealt. And what we've seen very consistently, and I'll show a couple charts on this in just a minute, but the market always gets very excited when the Fed pivots and they transition from rate hikes to rate cuts, or they just pause rate hikes. But the difference is, in terms of where we're going, where is the market going, that is much more a function of, are we going to be going into a soft landing or a hard landing? Again, much more important than the pivot is really rationale for why the Fed pivots. Now, we think that is a ways off, but when you look at really kind of where are we going to go from here, there's really three different scenarios that could play out to kind of resolve the situation that we see at hand here. And number one, this would be our base case scenario. We put about a 70% probability on this playing out. But what we see is that you have the Fed, they continue to raise interest rates, they continue to reduce the size of their balance sheet. That tightening really triggers a meaningful pullback in growth, a meaningful increase in unemployment, and we have some type of recession that plays out, and that recession initiates inflation coming back down closer to that 2% target. Again, highest probability event in our view is a recession playing out, and that recession helps to solve the issue that we have at hand here. The second scenario, which arguably is probably the potentially the worst case scenario for the equity market, is you have the Fed that continues to raise interest rates. They continue to raise interest rates, and inflation remains very, very high. Those sticky parts create some issues. And the reality of it is, and in our view, is that the longer the Fed has to hold policy restrictive, the deeper of a recession that you're going to see play out in the future. But still, hopefully this is not the case, but still is a scenario that could play out. And then third would be probably the lowest probability event, Is it impossible? No. Is it likely? No. But it would be that you have the Fed that tightens just enough to slow growth, but not kill it. You have inflation that comes back down, and they pull off a soft landing. Again, is it likely? No. But also, if you're an investor, this is a scenario that could come with meaningful upside to the equity markets. But I want to go back, Steve, just to look at, kind of to your question in terms of what is priced in. Interestingly, we speak with a lot of advisors, a lot of investment professionals. That view that it is going to take a recession to solve this issue, I would say that is shared by the majority of clients that we're speaking with right now. But interestingly, it doesn't appear to be fully priced in to equities right now. And I think this is really interesting in terms of looking at like where do equities typically price during recessions. Even with the derating that we've seen thus far this year on the valuation side of the house, we still see equities, and when I say equities, I'm referring to the S&P 500, we still see equities trading about 20% or so above past recessionary valuations. So looking at the last 10 recessions that we've seen play out in the US, and the PE of the S&P 500 on the recession, on the onset of the recession, you look at those, we've seen on average a PE of about 15 times earnings. Right now, as of today, we're trading at 18 times earnings. So still meaningfully above valuations that we've seen at recessions prior. Second interesting piece that we also see is if you look at earnings growth estimates, you look at consensus estimates, yes, they have come down so far this year and they've kind of softened, but even so, they're still positive over the next year. And what we're looking at on that chart on the right-hand side there is peak to trough earnings growth throughout recessions, throughout the last 10 recessions. And you can see on average, we've seen a pullback in earnings growth about 18% peak to trough throughout the last 10 recessions. And now even still over the next 12 months, you have positive estimates there, for earnings growth on the S&P 500. So in our opinion, and while this may be kind of the consensus viewpoint, you still see valuations that are elevated or trading above prior recessionary valuations. You still see earnings growth estimates that if we do head into a recession, we really do believe will need to come down just to reflect the hit to growth that you're going to see play out in the event of a recession. Now, is this logical? Yes, because there is still that that hope that we do see a soft landing, we avoid a recession. So there's still that hope being priced in. But in our view, if you do see the recession play out, we do see a little bit more of a re-rating or a derating that needs to happen in the equity market overall.
Yeah, that's been our feeling as well. I mean, despite the pullback this year, you're coming off 3 years of the average annualized return in the high 20% range. And pretty high valuations. I mean, they've come back down to average, but I think the feeling was that, you're going to continue to recover from this COVID downturn and they were going to grow into those multiples. Certainly if we see even a slowdown in earnings, not even negative earnings, you still get to fairly expensive stocks. So that I think is a concern even at today's levels.
That's a great point, Steve. And I think if you look at the valuations too, you look at the forward PE on the S&P 500 too, it has basically moved in the exact opposite direction as the 10-year yield so far this year. So most of the derating that we've seen thus far this year is justified simply for the fact that that discount rate is so much higher. And interest rates are so much higher, but you really haven't seen it play out in the earnings growth picture yet, which in our view is concerning, especially when you look at what's happening with PMIs and the reality that you have to, in order to get inflation under control, there has to be somewhat of a hit to growth. And so that ultimately that's going to hit consumer spending, which will hit the corporate earnings at some point, but not today, as of today, that really hasn't been reflected.
So Tim, one of the strategy firms I follow did a survey of investors, and I think something like 2/3 or more were expecting the Fed to cut rates in 2023, and maybe that's helping support equity values even within this downturn. It didn't sound to me like you're really expecting a pivot in the near future, at least.
No, and I think probably a lot of those hopes have been squashed, at least for the next 12 months or so. I think maybe Q4 of next year, you still have Fed funds futures that are pricing in somewhat of a cut. But I think the Fed's been very clear that, hey, this is a serious issue, and we're not going to be taking our foot off the gas until we're very confident that this situation is resolving. But I think what's really interesting, Steve, too, is you had that basically that Q3 early rally in Q3 in the equity market. A lot of that was on the backs of the fact that you have market participants that think the Fed is going to they're going to pivot. They get very excited about that. And I talked about this a little earlier, but I want to bring it up again because I think it is a really important point. Just in terms of where the market is going. And what I want to make sure we stress here is that when it does come time for the Fed to pivot, because there will come a time for that. We don't think that's going to be happening in the next year. But when that does happen, what's more important to be mindful of is what does the growth outlook look like, as opposed to just, okay, it's time to start allocating to equities because the Fed has stopped hiking interest rates. And I think it's really interesting. Our team did some work just looking at the last 4 Fed pivots. And what's really interesting is every single time you see the Fed pivot, the market gets really excited about that. But then after that pivot, it's the tale of 2 different directions there, based on what's going on in the economy. And I got a couple more slides I want to show on this topic. I think it's really interesting. And the difference is all about soft landing or hard landing. If you think back to the last 4 Fed pivots that we've had, they had 2 soft landings, 2 hard landings. Back in 1995, you had the Fed that pivoted from a rate hike cycle in Q1 of 1995. They paused hiking rates. Market got very, very excited about that. You had the S&P 500 that had an initial rally of about 17% during that time period. About July, August timeframe, they transitioned to rate cuts, and they were able to pull off a soft landing. And because of that, you saw an additional 23% upside in the S&P 500 in the next year after that. So a clear indication that soft landings are very, very profitable for investors. If you look at the other indication that we have of a soft landing here, back in 2019, again, pre-pandemic here, but you had the Fed that paused hiking rates in early 2019. Market gets very, very excited about that pause. You see about a 29% rip in the S&P 500. They start to cut rates in August of 19. You see the soft landing pulled off. You get another 19% rally in the S&P 500 after that. So soft landings have been very, very profitable. No surprise to any of us, right? But on the flip side of that, and I think this is particularly interesting, Steve, if you look at these other Fed pivots that we've seen that have resulted in hard landings, like 2000 and the financial crisis, you actually see a very similar narrative playing out early on, in that the market gets very excited when the Fed pauses interest rate hikes. So if you look at the early 2000s as an example, the April-May timeframe of 2000, you had the Fed that wrapped up a rate hike cycle. They paused. You see about a 14% rally in the S&P 500 after that, followed by just about a 17% drawdown. But then the Fed starts to cut interest rates there, and you see another about 10% rally on the news that the Fed is going to cut rates. So the market is getting very excited about pauses and cuts, But as we all know, you had the underlying economic issues that were playing out, and you saw about a 30% sell-off in the S&P 500, after the Fed began to cut rates. Same thing that we saw in 2006, 2007, very strong rally after the Fed paused. In fact, about a 27% run-up in the S&P 500 once the Fed started paused their interest rate hike cycle. Anticipation of cuts brings a little bit more good news, and then as we all know, there's no soft landing here, obviously, and you saw a significant downside for the equity market. So when we're looking at this and we're saying, okay, what is, are we going to get excited about a Fed pivot? We really want to be more mindful about what is the economy looking like and what type of hit to economic growth are the rate hikes going to have, because ultimately that's going to dictate a longer term total returns for the equity market here. But two things I think as an investor that we can take away from this. Number one, there obviously, as we looked at with valuations, if we are heading into a recession, there is likely going to be a little bit more of a derating, a little bit more of a pullback in the equity market. But on the flip side of that, the reality of it is it's not, this environment is not an environment that you can necessarily afford to be out of the market on. You can't just be going into cash. We see a lot of advisors right now that are going into ultra short bonds just because the yield is so high. If that's part of the bond sleeve, that's one thing. But if you're kind of rotating out of the equity sleeve and into cash and into that ultra short bucket, I think you have to go into that knowing that even though that soft landing might be a lower probability event, may not be your base case scenario, it's not an event you necessarily want to be on the sidelines for if it does play out. So yes, a hard landing is our base case. It might be yours as well. But again, in the event, in that off chance you do see a soft landing play out, you want to make sure that you have your equity exposure in place.
Yeah, it seems to me that the Fed has almost thrown out the soft landing scenario altogether. It doesn't seem to be what they're targeting, but yeah, it is tough. I mean, what do you do with client portfolios? And clients want to be invested, and they certainly don't want to miss things. We're starting now to see the pullback. We're starting to hear from clients like, yeah, I've got cash. Well, we should be aggressively getting this invested. And sure enough, I've got in the back of my head, valuations still look expensive. The Fed's still being aggressive. Inflation's coming down very slowly. So there's still a lot of risks out there. Kind of how would you set up a portfolio to kind of address that situation, but not miss a market rally if we do get one, and if this is kind of a bottoming process where we're at.
Yeah, it absolutely. It's probably the biggest question we're addressing with clients right now is like, how do you position around this? And our biggest message, I think right now, is we want to find ways to tie our lower risk dollars to the equity market as opposed to the bond market. Simply for the fact, if you think back to what I mentioned at the front end, and you look at the shared risks that you see across the equity market as well as the fixed income market, inflation, Fed, higher interest rates. The reality of it is that you're going to continue to see fixed income securities moving roughly in line, or at least directionally the same way as the equity market, because when those risks intensify, you see a sell-off like we have all year. And when you start to see some relief in those risks, you see a rally. You see a rally in bonds. You see a rally in equities. So from our standpoint, we really want to find ways to get more equity exposure in the portfolio. So when we do see those risks resolve, we're going to capture more of the upside there. And on the flip side of that, we're obviously not trying to say, hey, you want to just add long only exposure to, or more long only exposure to the equity market. But if we're adding that exposure in a hedged or a buffered manner, and we can kind of generate a similar risk profile to a bond allocation, we think that, because those directionally, we anticipate those to still move in the same direction, we think we can still hedge ourselves on the downside. But on the upside, we're going to be able to capture significantly more of the rebound when you start to see inflation come back down, when you start to see interest rates moderate a little bit. So that's really what we're encouraging clients to be thinking about. And a lot of what we've been hearing recently, and it's very contrary to what we were hearing in the first 3 months of the year from clients, where everybody was just trying to get out of fixed income, is that a lot of clients are being drawn in more toward the higher yield of bonds. And, yes, on the short end, but also, I would say in the core space as well. You look at the intermediate to longer end of the yield curve, simply for the fact that it's exciting, right? We haven't seen, a 4%, close to 4% yield on a 10-year treasury, or 4+% yield on a 2% note. That's definitely exciting. But what I think is really interesting here is, in what we are trying to encourage clients to think about, just based on the fact that we want to try to find ways to tie more of our lower risk dollars to the equity market, is even with yields where they're at, what is the risk reward trade-off that we're subjecting ourselves to with a core bond allocation, with a bond allocation right now? And when we look at this through the lens, not just in the fact that when you look at risks, there still are risks to the downside for bonds, right? Again, higher interest rates are part of the solution. Yes, a lot of that is priced in right now, but we really don't know how far the Fed is going to have to take this, how high the Fed is going to have to take rates to get inflation under control. We also don't really know the impact that balance sheet reduction is going to have on the bond market, simply for the fact that we only have one other instance that we can compare this to historically, and it only lasted about a year. And they took the balance sheet down about $1 trillion. We got to go a lot further right now. So there's a lot of unknowns out there right now when it comes to the interest rate picture. And again, what we're encouraging clients to think about is, what does that risk reward trade-off actually look like? And I want to show one other chart here. Another one of my favorite charts that we're looking at here is just looking at what are the drivers of bond returns. And unlike stocks, your core bond allocation, the total returns that you're going to get over a longer period of time are actually very, very predictable. And if you look at that chart on the left-hand side that we're looking at there, we're looking at a regression of the yield on the Bloomberg Barclays U.S. Aggregate Bond Index, with the 10-year annualized return thereafter. And what we have seen is that since 1980, starting yield has explained over 95% of the total return of the ag, with very little deviation one way or the other. Standard deviation of about 0.6 on this. But we also, just for giggles, on the right-hand side there, we actually are plotting out every single deviation that we've seen up and down from starting yield. You're looking at about a 1.2 to 1.4% deviation, max deviation up and down. So we know that really, when you look at the yield on the ag, 4.5 or so today, we with a high degree of confidence, we can say, okay, we're going to expect over the next 10 years, if we're buying in today, we can expect a return in the 4.3 to 4.6% range with a high degree of confidence. So what we want to think about is, okay, if we think about the risks that we're dealing with today of higher interest rates, is that extra juice worth it? Is the risk reward trade-off worth it? And again, we would encourage and steer clients toward, we would much rather have, until those diversification benefits return to our bond allocation, we would much rather have our exposure tied to the equity market over the bond market, because the upside is going to be limited, especially when you see these shared risks resolved. It's going to be limited. And we really just want to say, is that 4.5-ish% yield worth it, knowing that a 70 basis point increase is going to wipe out potentially an entire year's worth of yield on the allocation. So that's really, in terms of positioning, we're really looking at that, again, encouraging clients to think about that risk reward trade-off. And then on the shorter end, which I think has been a much more popular trade here recently, a lot more money flowing into the shorter end of the curve, it's really more a narrative of, when we see these risks resolve, it's very difficult, as we all know, to try to time the market. So we want to try to be cautious with that and would rather de-risk the equity sleeve, but still keep exposure on that end of the spectrum.
Yeah, and I think talk to a lot of people lately that are much more interested in bonds now than they have been in a long period of time, because obviously 4+% yield is better than we've seen since the financial crisis. But obviously the assumption there is that inflation is going to fall, because the real returns clearly are about the worst they've been, just because of we've had such a low inflation rate over all these years. So even though yields are quite low, there's still some risk there to that 4% bond return.
That's a great point too, Steve.
So Tim, tell us about your strategies as part of the solution.
Yeah, absolutely. So just so you know too, at Innovator, again, we focused on defined outcome ETFs and options-based strategies in the ETF wrapper. A lot of the payoffs that you've seen in the structured product world for years, we put those in the ETF wrapper. And really the goal is to give investors, an extended toolbox that they can use to be able to manage risk and return characteristics in your portfolio. So we have everything that spans from, hedged equity or buffered equity strategies all the way up to uncapped accelerated strategies, meaning that, you have, 2x the exposure of the S&P up to a cap, at 2x exposure without a cap. So we really span the spectrum here. I think in today's environment, what we've been spending most of the time doing is talking about our buffered ETF strategies, simply for the fact that this is a very challenging environment to be able to manage risk in. So we really, the ones I want to speak to a little bit today are just the defined outcome buffer ETFs. And very simply, when we talk about buffer ETFs, I'll just give a couple examples here. Really, what we're talking about is a strategy that is going to do a few things. It's going to give you upside exposure to a reference asset up to a cap, with a known level of downside protection over an outcome period. So at Innovator, we really, the bulk of our buffered lineup is over a 12-month outcome period. We have strategies on the S&P 500, the QQQ, EFA, EEM, IWM, really to span the gamut of the global equity market. But really, when you think about a buffer ETF, again, we're giving you have a known level of downside protection over the outcome period. And there's really, if you look at those blue boxes that I have up on the screen here, those are our three main buffer levels that we have. The all the way to the left-hand side there is BSEP. That is our September series, 9% buffer over the next 12 months. The P series in the middle there, PSEP, that's our 15% buffer that resets in September. So it gives you 15% protection over that 12-month outcome period. And then the U series on the right-hand side there, that gives you 30% protection over 12 months. So what's so unique about these strategies is you think about all the unknowns that we talked about at the beginning here. What the buffer ETF lineup from Innovator really gives you the ability to do is to be able to remove as many of those unknowns as possible by having that defined outcome. So again, if you look at all the way on the left-hand side there, BSEP, we know that from September 1 of this year, all the way through the end of August of next year, if the equity market sells off 9%, we know that we're going to be covered 100% of the way there, less the expense ratio of the ETF. On the flip side of that, what we also see is that you have exposure to the upside up to a cap. Now, the cap for the September series, because volatility is so high right now, because interest rates have come up, caps are fairly high. So you actually have a 24% upside exposure over the next 12 months. So again, if the market goes up on a price return basis, if the S&P 500 goes up 24% or less over the next 12 months, we know that we're going to capture 100% of that, and everything after there we're going to be giving up on. The middle bucket there, the 15% buffer there in September, we know that we have market goes down 15% or less over the next 12 months, we're going to be protected fully from that. And if the price return of the S&P is up with inside 17%, 17.5%, we're going to capture all of that price return as well. 30% is a little bit different. In order to generate any meaningful upside for clients, we actually do take on the first 5% of losses over the outcome period, but you'll have exposure to the first 14.4% of the upside. So again, the buffer ETF strategy, you have known upside participation, you have known downside protection in the strategies. We also have on the far right-hand side there, we have the 20% buffer on the S&P 500 every single quarter. This strategy in particular was built, we built this strategy as a means to be a bond alternative, where you're going to generate, a bond-like volatility, but you're tied to the equity market as opposed to the bond market. So you're going to have a new cap every single quarter and a new 20% buffer on the S&P 500 ETF every single quarter. So really, that's what buffer ETFs are in a nutshell. What is interesting, yes, you have the defined outcome. I think that's what is the most unique part about these strategies. Again, you can kind of remove a lot of those unknowns. You can enter the market with confidence. But also, what is very unique is we actually have on the S&P 500 ETF, on SPY, we actually have 12 different options you can choose from for 9% buffers, one every single month that you can pick. The 15% buffer, we have 12. The 30% buffer, we have 12 different options. So if you want to get the starting parameters, the defined outcome parameters, you can buy at the beginning of the outcome period and have that, that defined outcome. Don't get me wrong, you can buy at any point in the outcome period. We have clients that buy with a month, 2 months left. And at any point in time, we have some tools on our website that will tell you how much buffer, how much cap you have left remaining over that outcome period. Intra-outcome period, it looks a little bit different. What we do to construct these strategies is we actually, we use flex options. So we use options underneath the hood of the ETF here, and really, the way that works is there's really a couple different layers. We have a call option that gives us 1-to-1 exposure. We buy a put spread that gives us the downside protection. And then we got to pay for that downside protection. So what we do is we trade away our upside, which is why all of our strategies have a cap. So we sell that cap at the exact level necessary to be able to pay for the cost of protection. So they're simple strategies, but what you'll see is, because as we know with options, these have a time value component to them. So what you'll see with these strategies is, even though you have a defined outcome over the full outcome period, you'll still see this, I like to call it intra-period movement or intra-period noise, based upon the time value component that's left of those options positions. So when we look at these strategies in today's environment, you look at what's going on in the markets. I really like to encourage clients to think about these strategies as the risk management toolkit that will allow you to dial your equity risk down as little or as much as you want. And the 9% buffer strategy very, very consistently is going to have about 70% of the volatility of the S&P 500. You go to the 15% buffer strategy, that's very consistently going to have about 40 to 50% of the volatility of the S&P 500. The 30% buffer is going to have about 30% of the volatility. And BALT, that 20% quarterly buffer, is going to have about 10% of the volatility of the S&P 500. So you have the known outcome, but you also have the ability to, if you have clients that want a very precise risk profile, or they can only stomach a certain amount of risk, these strategies really give you the tools to be able to kind of precisely dial in that risk reward profile, because we know what the buffer is, we know what the cap is. We also know that they trade very consistent with the reference asset. So again, I would encourage you to think of these as almost like that risk management toolbox.
Great. We've had several questions come in. I do want to get to those, but maybe just before we do, Tim, you could take a few minutes to explain, how, in the sense of constructing a broader portfolio, how you would use these.
Yeah, it's something we do all the time. And again, as part of our research efforts here at Innovator, we actually have an entire solutions team that's dedicated to portfolio optimization using defined outcome ETFs. Again, the buffer ETFs are one part of that. We also have the accelerated suite or stacker ETFs that are in there as well. But really, what we try to do with these strategies, again, every one of them has a very distinct trade-off between risk and reward. And there's really, again, there's no guesswork with that. So really what I would encourage you to do with these strategies is think about these as what are your clients trying to solve for? And how can we replicate that appropriate risk profile using these strategies? Right now, I'd say probably one of the most popular model portfolios that we have is a 60-40 alternative strategy, which is designed to generate a 60-40 like volatility, but get the bond exposure out of there. Get and replicate the allocation using buffer ETFs. And so that's one option that you can have, again, because you're not taking on the full risk of the equity market. We also see a lot of different clients just using this to lean into a view on the equity market. Hey, we think that the market's sold off 20%, 25%. We don't think we're going to see an additional 9% downside over the next 12 months, but we're a little bit concerned that we might see 5 or 6%. And we don't think the market's going to go up more than 24% through the cap. So you can kind of shape that allocation based upon your view of the equity market. And then finally, we really see these as kind of a low volatility alternative as well. You think about low volatility equity strategies. One of the things that you see with those is that there's inconsistencies. You have, yes, they work most of the time. Low volatility stocks tend to continue to be low volatility stocks, but they don't always work, right? You have, I think COVID was a perfect example of that, where you had a lot of these lower volatility pockets of the market that got destroyed. And some of those higher vol pockets of the market, like tech stocks and growth stocks, did very, very well, just given the environment. And I think one of the most powerful benefits of these strategies is that they really eliminate that guesswork. We know that you're going to have a very consistent profile relative to the reference asset. So number of different ways that you can utilize these strategies. I would encourage you, if you're curious about these, we have some great tools on our website. We also, again, I would encourage you to utilize the Innovator Solutions team. We're happy to optimize portfolios based on a specific return target, specific risk target, or a specific client need. So you can reach out to your consultant on those. So those are just many, many different ways, Steve, that these are utilized. Those are just a few of the the top ones that we're seeing right now.
Okay, great. So yeah, we have had some questions come in. I think one just kind of a clarification, and maybe the website's the answer, but probably you can take it live as well. Someone says, to clarify for BSEP, if S&P is down 9%, then BSEP returns should be flat, excluding expensive, with a max upside of 24%. That's the question.
That is the correct way to think about it. Yes. So if the price return of the S&P 500, if the S&P sells off 9% in the year, you will expect to be flat less the expense ratio of the ETF. Now, the one if you're looking at this intra-period, let's say you buy and the S&P 500 is down 10% in the first month of trading, again, because there's that time value component to the options, you might see BSEP trading down 4 or 5%. Now, if the market rallies from there, you're going to capture that upside back to zero, back to that original position plus the 24% cap. So again, outcome period, there's going to be some of that noise. Again, there's a lot of clients that we have that trade these very tactically and look for intra-period opportunities. But yes, the way that was stated originally was spot on over the outcome period.
Okay, perfect. We have someone that wants to know, with bonds and stocks trading stocks directionally moving together, how much lower can the broader bond market go from here? Not sure I want to know.
Yes, it's a great question, and again, I think it's really going to be dictated upon how long it takes. It takes the inflation picture to start to turn, and again, we would consider those risks to be skewed to the downside from here. Simply for the fact that if you look at the last 10 tightening cycles from the Fed, what's really interesting is from the first hike to the last hike, believe it or not, you've actually seen on average CPI increase 1.2%, or sorry, 1.9% over that time period. And there's only been one instance when the Fed is still hiking rates where inflation actually comes down. So the reality of it is, again, it can take time. It could potentially take a lot of pressure higher on interest rates. So, hopefully we finish up with the Fed funds rate in that 4 to 4.5% range. But the reality of it is, we don't know, and we don't, quite frankly, in the U.S., we don't have a lot of scenarios or alternatives to be able to compare this to. Yes, you have the 70s and the 80s. But there's not a lot of situations where inflation has been this high, and never before have we printed $5 trillion and pumped it into the system before. So, in my opinion, it's a losing game to try to predict. We think you just need to be positioning around that, stay focused on the portfolio construction process, hedging our bets, hedging our interest rate risk altogether, and again, looking at it through that risk-reward trade-off.
Yeah, it seems like a Fed that most people haven't seen in their careers, unless you go back pre-1995. I mean, there's been quite a focus on asset prices in addition to inflation and employment, where maybe there's the focus is more on inflation at this point, and maybe they do keep hiking until inflation starts coming down. Yeah. But we will see. But that does take us on to another question. Could you talk about the sources of inflation, how these may cause the path of inflation to differ from or replicate the past?
Yeah, that's a really good question. I'd say the two that we have been focused on, well, actually three, would be the shelter costs, which you look at rent prices tend to be much more sticky. We're seeing record increases there still on the rent side of the equation. So those stickier pockets tend to be a little bit more concerning relative to kind of what we've seen historically too. If you look at like the 1970s and 1980s, food was a very, very tricky one to try to get those costs down. And you didn't see any meaningful drop in inflation until you did start to see food costs come back down. And so, right now, even with the last print, we're still seeing, year-over-year gains that are, seems to be breaking records every single month here. The one that I think is really interesting is the energy conversation here right now. And if you look at, a lot of the energy drop has certainly been encouraging. It helps people at the pump every single day. But a lot of that gain that we've seen has been somewhat artificial. A lot of states, you have the tax holidays for gas prices. You also have the release of the strategic reserves, which is, if you look at gas prices and energy prices, it's really kind of moved in lockstep with the release of those barrels. So we're really kind of keeping a close eye on when that, again, not to call it all artificial, but a lot of it has been, when those artificial costs or those artificial drivers kind of fade and you stop pumping all this extra, releasing all these excess reserves into the system. What is that going to do for energy prices and gas prices as a whole? Because if you look at the encouraging signs that we've seen from inflation thus far, a lot of that has been driven by energy. Now, again, the Fed strips that out, but the reality of it is consumers drive economic growth in the U.S. and really across the globe. And if they're pinched, they're spending all their money at the pump, that's going to have a pretty big impact on what we see in the economy. So those are three areas that I'd say we're keeping a close eye on. Not that other pockets don't matter, but I'd say those three in particular are the ones that we're really tracking very closely.
We had a question come in with the registrations, and we kind of talked about this a little bit, but what the impact of a mild recession would be on equities and real estate. I guess this participant has given up on the soft landing as well. It's moved on and wondering what you see the impact of something like that.
Yeah, a mild recession, that's interesting. I'd say right now, when you look at the hit that we've seen to valuations, it's really pricing in, I would say, a moderate hit to growth. If we see a mild recession priced in, we certainly would see a little bit more downside to the equity market. Again, in terms of forecasts out there, you talk to different shops, you'll get a different viewpoint in terms of the potential severity of the recession that is expected. We would kind of be in the camp of that's really not something. It's very difficult to say right now because we don't know how far the Fed is going to need to, or how far the Fed is going to need to have to go, and how long they're going to need to keep policy restrictive. And ultimately, we think that's going to determine the overall, call it, severity of whatever type of recession that we do see play out. And I think what's really interesting on that is the Fed. Right now they're hiking rates faster than we've ever seen in modern history. Like the curve is like this, everything else is like that we've seen historically. And just like they were slow on the way in, what we're really hoping is that they're not delayed in their wrapping up of the hike cycle, because you're not going to see, again, the hike rates, that impact on the economy, it doesn't come right away, right? That plays out over time, 9 months, 12 months later. So the fear is that you just hike rates so aggressively right now, further than they need to happen, further than they need to go, and then you kind of make that severity a little bit more than it needs to be. So that's what we're thinking about there. On the real estate side of things, quite frankly, not a sector that we dive into a whole lot. But you look at interest rates, I think you're already starting to see buyers are getting priced out of the market. So what's the option of that? You have sales that continue to slow down, or you have prices that have to come down to increase affordability for buyers. I know one of the trends that we've been seeing over the last few years has been away from that first-time home ownership and into more like the build-to-rent landscape, where you have just new single-family homes that people can rent as opposed to buying. If affordability keeps getting squeezed, we would anticipate all the tailwinds that are already behind that landscape to continue. But Steve, anything from your side on real estate in particular?
Yeah, well, I mean, going back to equities, I think you, during their presentation, or one of the slides you had, is just on valuations and the earnings. I mean, frankly, so I think a lot of people are saying, yeah, mild recession, but you haven't really seen, I think, stock prices react to the potential of falling earnings estimates. So that's that's of concern. As far as the real estate side, yeah, I mean, obviously that is mostly affected by interest rates at this point. I mean, and it's definitely sector by sector, right? Multifamily housing, there's still a housing shortage that will remain with us for some time. Higher rates are affecting interest rates are affecting cap rates, but I don't think that's going to change the fundamental dynamic of of the housing market in particular. So, and if you get outside of that, obviously things like retail and office have their own interesting dynamics.
Absolutely.
Well, great. We're just about an hour, so I think we're probably used up our time. But Tim, I want to thank you for spending an hour with us today, and thank all our participants for joining us.
Thank you, Steve.
All right. Thanks, everyone.
Take care.